3 years of double-digit gains. What actually changes in 2026?
Honestly, the market gets less forgiving, not broken. Just tighter. Fewer things need to go right for prices to hold up, and fewer things need to go wrong for volatility to show up.
So this isn't a crash call.
No. It's more about fragility. The upside's still there, but it's narrower.
Okay, then why aren't the big banks calling for a recession if growth is slowing?
Because demand isn't falling off a cliff. Supply is the issue. JP Morgan's base case is growth slowing toward about 1% by late 2025. Then you get this weird bounce above 3% early in 2026 from delayed tax refunds tied to the OBBBA. And after that it fades back to 1 to 2%.
That's not exactly a clean cycle.
Not at all. Citi's global number is around 2.7%. Nothing exciting, but after years of missed recession calls, that kind of boring growth has credibility.
What's doing the constraining then?
Labor. Immigration restrictions are tight enough that the working-age population may actually shrink. So you're looking at payroll growth around 50,000 a month and unemployment topping out near 4.5%. That caps growth, but it also keeps the floor under the economy.
Inflation keeps refusing to leave the conversation. Why?
Tariffs. That's the big one. JP Morgan estimates the tariff hikes pulled in over $29 billion a month in mid-2025, and retailers ate a lot of that cost upfront.
Which they're not going to do forever.
Exactly. As that gets passed through, CPI likely drifts higher into mid-2026, peaks below 4%, then slides back toward 2% by year-end. Lower energy prices and easing shelter inflation help on the way down.
So how boxed in is the Fed here?
Pretty boxed in. Goldman's view is, as long as inflation stays anchored, the labor market sets the pace of cuts. Morgan Stanley goes a step further and says any cuts in 2026 aren't panic. They're an admission policy stayed too tight for too long.
Alright, equities. 3 big up years usually end badly. Why is this time different?
Earnings. That's the whole story. You've had 4 straight quarters of double-digit earnings growth, even with rates above 4%.
Still, valuations feel heavy.
They are. And that's where the debate is. Morgan Stanley is the most constructive. They're at 7,800 on the S&P, leaning on earnings, OBBBA tax relief, AI efficiency, and eventually Fed easing.
And the pushback?
Goldman's concern isn't multiples blowing up. It's concentration. Top 10 stocks are about 40% of the index. If earnings slip, there's not much cushion. Citi kind of splits the difference. Bull market intact, but choppier, with the S&P around 6,900 by mid-2026.
We keep circling back to AI. Bubble or backbone?
Backbone. But it's doing a lot of work. No one's calling this a dot-com replay because the infrastructure is real.
How real?
Data center capex is already about 1.2 to 1.3% of GDP. Morgan Stanley says less than 20% of the roughly $3 trillion in projected AI capex has actually been spent.
That sounds like a long runway.
It is. But it also means more financing, more tech debt, and eventually pressure on investment-grade spreads. AI is now carrying a disproportionate share of earnings and capex growth. When one theme does that much, even small disappointments matter.
So if you had to sum up 2026 without the drama?
It's the year markets stop giving you free passes. Growth slows, but holds together. Inflation cools, but still limits policy. Stocks can grind higher, but volatility rises, and expectations get punished faster.
So not the end of the cycle.
No. As JP Morgan frames it, growth and inflation just drift back towards subdued levels by the end of 2026. The cycle's still alive. It's just tighter.